Today is Sunday, January 25, 2026, and the market is currently closed. Plug Power stock last traded at a closing price of $2.50 on Friday, January 23, 2026, at 4 p.m. EST. This price represents a drop of 3.47% during that final session of the week, with the intraday range swinging between a high of $2.66 and a low of $2.45. While a 3.5% slide might look like standard volatility for a high beta ticker, the underlying story here is far more complex than just a red day on a screen. Most investors looking at the ticker right now are focused on the immediate price action, or perhaps the news that dropped just as the weekend started regarding the 100-megawatt electrolyzer installation in Portugal. But the reality that is likely to catch the market off guard on Monday morning isn't just about successful hardware deployments, it's about the massive short interest that has quietly climbed to nearly 25% of the float. This creates a fascinating tension where the expectation is a slow grind lower due to cash burn, but the reality is a coiled spring where any piece of positive fundamental news can trigger a violent move upward as short positions are forced to cover. The general belief among the retail crowd on popular investing sites is that Plug Power is a perennial show-me story that never quite shows enough. This skepticism is well-earned after years of dilutive share offerings and missed margin targets. However, if you look at the recent institutional activity, a different picture starts to emerge. While the casual trader might be moving toward other options, we are seeing major players like BlackRock and Goldman Sachs significantly increasing their positions in the most recent filings. This institutional appetite suggests that the big players are looking past the current quarterly losses and focusing on the physical infrastructure being laid on the ground. When you see a company completing massive projects like the Galp refinery installation in Portugal, you have to realize that the transition from a research and development firm to a legitimate industrial manufacturer is actually happening, even if the stock price doesn't reflect it yet. This gap between the public's perception of a struggling startup and the reality of an expanding global footprint is exactly where the most interesting opportunities are found in online investing. For those using the Robinhood app or exploring various Fidelity investments, the sheer volume of over 100 million shares traded in a single session tells you that this is one of the most liquid and debated names in the entire clean energy sector. It isn't just a speculative play anymore. It has become a central battleground for the future of industrial energy. If you are managing your own individual brokerage or using tools like Schwab Intelligent Portfolios, you have to weigh the risk of high cash burn against the potential for Plug to become the dominant provider of the entire hydrogen value chain. The recent price action has been a roller coaster. Just a few sessions ago, the stock saw a massive 16% surge following a debt fix and a deal with NASA, only to give back some of those gains as the broader market digested macroeconomic pressures. This is the momentum trap that many analysts warn about, where the stock looks like it's breaking out only to pull back and frustrate the bulls. But for those looking for investment help through platforms like Interactive Brokers or SoFi Invest, the technical setup at $2.50 is becoming a critical line in the sand. We are seeing a massive tug-of-war between retail sentiment and institutional accumulation. Comment below how many shares of Plug Power stock you currently hold, or if you've moved your capital into safer Fidelity ETFs recently. Looking at the business model, Plug is trying to do something incredibly difficult. They are building the infrastructure for an entirely new energy economy. They aren't just making fuel cells, they are producing the hydrogen, building the transport logistics, and maintaining the fueling stations. This is a capital-intensive strategy that has scared away many conservative investors who prefer the steady dividends of Fidelity mutual funds or the safety of a Fidelity brokerage account. But the sheer scale of their ambition is what keeps the trading volume so high on the Robinhood trading platform. They are currently targeting a massive market in material handling and e-mobility, sectors that are under intense pressure to decarbonize. The reality of their financial situation is often the hardest part for investors to swallow. In the most recent quarterly reports, the company showed a net loss that widened compared to previous years, largely due to the massive costs of scaling their green hydrogen production plants. This is the expectation that they will continue to lose money for the foreseeable future. The reality that could change the narrative is the path to positive gross margins. Management has been vocal about the fact that as their internal hydrogen production comes online, they will no longer have to buy expensive hydrogen on the spot market to fulfill their customer contracts. This pivot from being a consumer of energy to a producer of energy is the pivot that could finally align the company's financials with its industrial potential. Comparing Plug to other high-profile names like Tesla stock or Nvidia stock might seem like a stretch to some, but the underlying theme is the same, providing the fundamental picks and shovels for a massive technological shift. While Nvidia provides the chips for AI, Plug wants to provide the molecules for heavy industry. This is why you see so much interest on investing sites and why the Robinhood investments community stays so engaged. They are looking for the next big industrial leader. For those using a SoFi active investing account or a Fidelity trading platform, the volatility is both the risk and the attraction. One thing that doesn't get enough attention is the company's green hydrogen highway plan across Europe and North America. This isn't just a vague concept, it involves real partnerships with companies like Galp and Renewable. The installation of the 100-megawatt electrolyzer is a tangible milestone in this plan. It proves that their technology works at scale in a demanding industrial environment. This is a far cry from the small-scale pilots of 5 years ago, yet the stock is trading at a fraction of its all-time highs, creating a massive discrepancy between the company's physical progress and its market valuation. Institutional holders now own over 500 million shares, and the fact that we saw increased positions from over 200 different institutions in the last cycle is a sign of smart money moving in while the retail crowd is fearful. When you use a Robinhood cash management account or explore the SoFi trading platform, it's easy to get caught up in the daily noise, but the institutional perspective is usually measured in years, not days. They are betting on the long-term viability of hydrogen as a fuel source for hard-to-abate sectors like steel manufacturing and long-haul shipping. As we move toward the special meeting of stockholders on January 29, 2026, the tension is only going to increase. Shareholders will be voting for proposals that could significantly impact the company's capital structure. This is the kind of event that drives massive volume on the Interactive Brokers platform and among those who prefer self-investing. If the company can prove it has a clear runway without needing another massive dilutive capital raise, we could see a significant re-rating of the stock. The expectation is more dilution. The reality of a clean balance sheet would be a massive catalyst for a short squeeze. For the active trader, the intraday moves are where the action is. Using the Robinhood app to track fractional shares or setting up alerts on the Fidelity mobile app is standard practice for staying on top of these swings. The volume is consistently higher than many blue-chip stocks, indicating that this is a primary vehicle for speculators and hedgers alike. Whether you are looking for long-term wealth management through Fidelity Wealth Management or trying to catch a quick swing via Robinhood crypto and stock trading, Plug Power provides the kind of volatility that forces you to be right about the direction. In summary, the story of Plug Power at $2.50 is a classic case of the market pricing in the worst-case scenario while ignoring the physical progress on the ground. The expectation is a continued struggle with profitability and a potential cash crunch. The reality is a company that is successfully installing massive industrial hardware, attracting significant institutional backing, and sitting on a massive short position that could fuel a rapid recovery. The contrast between the two is what makes this one of the most compelling names in the energy sector today. As the hydrogen economy continues to take shape, the companies that own the infrastructure will be the ones that hold the power. Whether that translates to a win for your individual brokerage account depends on how long the company can bridge the gap between its high-cost present and its high-revenue future. The central insight here is that the transition is no longer theoretical. The hardware is in the ground, the electrolyzers are running, and the institutional support is deepening despite the retail skepticism. The reality of Plug Power's global footprint is far more substantial than the current stock price suggests, creating a high-stakes environment for anyone involved in online investing. For those using the SoFi Robo-Advisor or a simple intelligent portfolio, this might be too much heat, but for the active investor who thrives on the tension between market narrative and industrial reality, the coming months will be a defining period. Would you like me to analyze the recent institutional buy-ins for Nvidia stock or Apple stock to see how they compare to the activity